Good afternoon. My name is Erica James, Dean of the Wharton School of the University of Pennsylvania. We're thrilled to have you joining us today. An expansion of the Tarnopol Lecture Series, Beyond Business, is an ongoing conversation that explores the most complex and pressing issues impacting individuals and organizations across the world. This year's three-part series shines a light on how analytics, artificial intelligence, and machine learning are providing viable pathways for solutions in every domain. Today, we'll talk about how analytics is influencing critical decision-making in the field of finance. In December, we'll look at how data and analytics can offer surprising ways to increase accountability and drive social good. And then in January, we'll talk about how data comes into play both on and off the field in professional sports. Today's conversation will be followed by an audience Q&A. Please use the comments section to submit your questions. So today we're asking, how can data help govern and grow the economy? More than ever, data is influencing critical decision-making in the field of finance, whether it's using machine learning to inform investment banking practices or algorithms to detect white-collar crime. Analytics is shaping finance in new and nuanced ways. How will the financial landscape evolve with these trends, and what obstacles and opportunities should we expect? I'm excited to be joined by my colleagues at the Wharton School. Professor Michael Roberts is a professor in the finance department, and Dan Taylor is a professor of accounting and director of the Wharton Forensics Analytics Lab. Thanks for joining me, guys.
Thank you.
So, Michael, I want to start with you. What do you see as the major advantages from using analytics in finance? Some people wouldn't put those two things together, but we do so at the Wharton School. So what does that mean, using analytics in finance?
Sure. So broadly speaking, it's analytics in finance is about improved decision making through better informed decisions. And interestingly, analytics and finance actually, in many ways, are one and the same. You can trace back the relationship or the use of analytics in finance quite literally centuries. So we often think of analytics and finance in the context of capital markets, as you mentioned. We see increased price informativeness as well as greater liquidity, lower transaction costs. But I think it's really important to emphasize that financial analytics play a critical and growing role beyond capital markets. On Main Street, we see more effective capital budgeting because of data integration and exploitation via data science initiatives. And among households, we're seeing improvements in budgeting, retirement savings, asset allocation, and credit usage, due largely to the democratization of data and technological innovation from fintech.
I hear you say that, and I think about my own personal experience when Quicken came out. The access that I had to be able to manipulate my own personal financial budgeting practices was really critical. And of course, things have evolved so much since then. Dan, would you add anything to this?
Well, I think that the other way to expand on that is to see, how we can use analytics to really, discipline bad actors, and that's where a lot of, as you know, that's where a lot of my work is, and to use analytics to sort of, do good within the scope of finance, beyond, let's say, investing decisions, but in terms of detecting and deterring white collar crime.
Yeah. I want to talk with you more about that in just a moment because you and I share a similar interest in that regard. But Michael, back to you for just a second. Part of your research explores machine learning in corporate finance. First of all, tell us, what do we mean by machine learning, and what role do data and analytics, and by extension then machine learning, play outside of the capital market space? You touched on it a little bit, but let's integrate that with the notion of machine learning.
Yeah, so I like to think of machine learning as really just statistical modeling of data for various uses, be it for understanding how data is generated or for predictive purposes. It's been, sort of co-opted by computer scientists, but really in many ways has been used by statisticians and economists and social scientists for many years. So my focus, let me give you a little bit of context here. So when I think about my research agenda, it's really aimed at using data, analytics, and machine learning, that is predictive and inferential models, to understand and guide financial decision-making for investors, banks, and non-financial firms. What I've been focused on most recently, what I find most interesting, is the use of data and predictive models in areas of finance that haven't historically exploited big data and these models. So think of due diligence for mergers and acquisitions or buyouts or capital raising activities. Right, they all require valuations using discounted cash flow or market multiples. But if you step back and think about it, Erica, we're really just trying to get the value of a company or an asset based on what we think is going to happen in the future. And this is just an ideal setting for big data and machine learning, i.e., advanced predictive models. And what we're already seeing is some really impressive results in terms of improved predictive accuracy and increased benefits to both shareholders and non-financial claim holders of firms.
Thanks for that. Dan, so I want to shift over to some of your research. So I said a moment ago that you and I share some relative interesting research themes. I study crisis leadership. And over the past decade or so, what we've observed is that one of the most prominent forms of business crises and scandals is this notion of mismanagement, and that might include financial irregularities and corporate fraud, et cetera. And I think that touches on some of the work that you do. So can you describe a little bit about your own research and how data and analytics help potentially minimize things like insider trading?
Yeah, so my research agenda is really around using data analytics, sort of similar tools to Michael, machine learning, artificial intelligence, algorithms, to basically understand the determinants or motivations behind white-collar crime and methods to detect and eventually, hopefully, deter white-collar crime, whether it be, sort of the accounting fraud, the perennial accounting fraud, or insider trading. And sort of within that sort of overarching framework, you can think about embedding analytics using algorithms in three different types of systems. One would be like an internal system that a company might use, like a large bank might use, to monitor the trading of its employees or how its employees are operating. Another is an external system that a government enforcement agency or stock exchange might use to monitor markets, to do market surveillance. And then the third is, and Michael somewhat touched on this, is you could think of this as like a due diligence system that an auditor or a hedge funder might use to monitor its portfolio companies, or in the auditor case, monitor their audit clients. And analytics can basically take an existing team, and you can bolt on an analytics platform and some algorithms and actually drive new insights that you wouldn't otherwise be able to see. So analytics is, the way I think about it, is separating signal from noise. There's lots of data out there, and analytics helps you filter through that data to detect important nuggets. And you can use those nuggets for investing decisions, whether you're a corporation or you're an investor, and you can also use those nuggets to identify bad apples, so to speak. And that's what most of my research is focused around, is the bad apples.
So I'm curious, have you seen an evolution either in more reporting or at least awareness of some of this white collar crime because of the evolution of machine learning and analytics? Or like, how have you seen the prevalence of bad actors, as you've described, evolve in the past decade or so?
I think really it's let's call it the major innovation is more on the detection side. So FINRA, which regulates the stock exchanges, and the Securities and Exchange Commission have wholeheartedly embraced algorithms and analytics for market surveillance. And so they have, algorithms you can, some of which are publicly available. You can Google around and look at them. Algorithms for detecting insider trading, and they kind of give some, details around the edges about how those algorithms work. So it's not that, we're in the 1980s or the 1970s and people are sifting through reams and reams of paper to detect outliers. We're letting the machines do that. And that allows, frankly, cash-strapped government agencies to be more efficient with the use of their time. And on the internal side, I think auditors have started to embrace the use of analytics to do their audit work, because they know that they can use analytics in some sense to substitute for manpower, because a lot of accounting is rules based, and if it's rules based, that means it's suitable to some sort of algorithmic programming.
Thanks. So let's shift gears and talk a little bit about fairness and equitable playing fields in this context. So, Michael, financial market participants have varying degrees of competence in AI and machine learning. Some are concerned that this could create a new class of haves and have-nots and increase discrimination and inequities among participants. What are your thoughts on ensuring a human-centric approach?
Okay, so I think there's 2 points in there. First, on the equity question, I don't think this is a new concern or one that's unique to data and analytics, or even finance for that matter. I think we need to think about data and analytics as investments. First movers have to be incentivized to take risks to make these investments. But over time, what'll happen is competition will erode those returns, and we'll see a diffusion of technology and knowledge to the broader population. Something we're already seeing with inexpensive and widely available robo-advisors and electronic payment systems. The second issue in there is regarding adverse outcomes, things like discrimination that you mentioned. And so the potential for these adverse outcomes of machine-oriented decisions are a bit more pernicious. And interestingly, one I've seen firsthand in working with a financial intermediary. So the problem was that historical lending practices had been concentrated in areas that underwent significant demographic shifts in recent years. So because the nature of the data had changed, the models that were trained on historical data were unable to accurately assess credit risk for the new and emerging demographic. Consequently, model predictions would have been skewed in a manner suggestive of discrimination were it not for the data science team's deep understanding of the changing demographic landscape and the machine learning models themselves. So I think there are really 2 broad lessons worth mentioning that can be drawn from this experience. First, it's data, not models, that are the most important input to analytics, automation, and machine learning, or AI. And 2, for many situations, we can't remove the human component from decision making. Rather, we need to think of the 2, human and machine, working in concert and amplifying the benefits of both.
Yeah, and as I'm listening to you, I'm also thinking about, from an organizational perspective, the need to align both your data scientist with your leadership, and that ability to communicate and understand what the data is telling you, and to be able to translate that to leaders who are not AI specialists, but who understand the impact of the information that they're being heard, or that they're hearing, on the decisions that they're making, and therefore on the stakeholders that they're influencing.
Indeed.
Great. Dan, at the same time, we also see huge opportunities for analytics in leveling the playing field for participants with democratized access to business intelligence. What net outcomes might we expect?
Yeah, I mean, I think here it's important to think about, let's say, various gaps that analytics could either create or resolve. The first is sort of like, you can think about this as the gap between market participants. So, for example, high frequency traders versus retail investors, right? So, on the one hand, you might think that analytics might enable high frequency traders or someone with a hedge fund very sophisticated to earn greater profits, and those profits have to necessarily come at the expense of someone else. Alternatively, you could think about deploying analytics. It's often used in a system called payment for order flow to democratize finance and help spur retail investor participation and get retail investors more active in the market. There, I think, in the private sector, you're going to have profit-making opportunities, and I think you're going to see that sort of sort itself out based on those that can make profits from analytics adopting it and those that potentially can't, not doing so. But the other gap that I'm more concerned about, given my work, is the gap between market participants and regulators. In this case, let's say regulators or enforcement attorneys, right? So if you have, let's say, to use an analogy, Dr. Moriarty is the arch enemy, the nemesis of Sherlock Holmes. If Dr. Moriarty is using analytics to commit, increasingly greater crimes, and Sherlock Holmes, doesn't have a cloud presence, or Sherlock Holmes, doesn't really understand analytics, then it's going to be much harder for him to catch Dr. Moriarty. And so I think you're starting to see regulators recognize this, that the crimes are getting increasingly sophisticated, increasingly difficult to detect, and they're starting to tool up with their analytics. And you're kind of seeing this sort of filter down into the education. Law schools now, law schools really aren't known for focusing on data and quantitative analysis, but you do see law schools now start to have a class and some sense of de minimis trading in analytics, with the hope of shrinking that gap between potentially attorneys who either have to enforce or defend clients, enforce the law, and the actual market participants. So that's the gap that I'm really concerned about.
Yeah. And Michael, would you add anything to this discussion?
Yeah, let me take it in a somewhat different direction than Dan when I think about the opportunities for analytics to level the playing field. We're seeing the democratization of data and analytics, perhaps most personally in the household finance, personal finance space. So if I think about how I bought my home many years ago, we'll just round it to many, right? I walk into my bank, I ask what the mortgage rates are on different products. Maybe I call a mortgage broker. But now just search for mortgage rates and you see dozens, if not hundreds of sites presenting mortgage rate data and corresponding payment terms from hundreds of intermediaries across the country. So you can shop for mortgages much more effectively, much more efficiently. Look at Zillow and Redfin. When I want to buy or sell a house, I'm no longer in the dark or at the mercy of a realtor. I've got access to data across the country. Comps are just there, freely available. Yahoo Finance, you want to do financial statement analysis on a company? I can just go up onto Yahoo Finance and I've got dozens, if not hundreds of different metrics to look at. And I think next up, frankly, is healthcare, which is really where the greatest potential for societal benefit lies, in my opinion, from this move towards data and analytics and increased transparency, frankly.
Thanks. So let's shift gears again and talk about some of the risks and obviously some of the challenges associated with analytics in the finance space. So Michael, let's continue with you for a moment. How robust is the technology that's driving data analytics in the financial markets? And what do you see as some of the biggest shortcomings and how are they being addressed?
Yeah. Well, so let me try and stay away from the IT angle, which obviously isn't my forte here, but is an important aspect of your question, I think. So incentives and competition ensure that technology is robust to a degree. There's just too much money at stake for it not to be. That said, it's clearly imperfect. We don't have to go back too far to recount a number of significant problems. Think LTCM, long-term capital management, AIG, the flash crash of 2010. Data analytics and financial models played a central role in all of these events. We've also seen recurring problems in the crypto space since its inception. And hopefully we'll get a chance to touch on FTX a little bit later. But I think it's critical to distinguish between technological failures and human failures. Now, how can you address these shortcomings? I think there's several ways. First, better informed participants. that don't blindly rely on technology, data, and analytics will make a big difference. There has to be personal agency because it's going to help discipline behavior and ensure robustness. Second, markets themselves must install and enforce tripwires and guardrails. And now I'm eking a little bit into Dan's expertise here that can handle the new technological reality. And finally, of course, regulation is just essential to investor confidence and overseeing these new technologies related to data and analytics that, again, come back to boosting investor confidence and ensuring that we're on somewhat of a level playing field when we invest.
Yeah. So, Dan, Michael mentioned you in his response. Would you want to add to anything that he said?
I would just echo that, analytics does actually provide, I would say perhaps for one of the first times in history, it does provide regulators, government enforcement agencies, due diligence professionals with the ability to be proactive. So if you look back on notable accounting frauds or notable corporate or business failures due to fraud, oftentimes the enforcement agency or the regulator will show up afterwards and effectively conduct an autopsy on the murder and say how the murder was committed and whatnot. I think we're moving to the point where with analytics that can be deployed relatively simply and cheaply, as opposed to teams of lawyers, you can actually get to a point where you're proactive, where you're doing quantitative risk assessment. What's the risk of fraud for this particular company? What's the risk that this particular trade is made based on private information? And that would then allow the regulator to be more proactive and more efficient with how they allocate their resources, right? So, you can think about a police commissioner using analytics to allocate his potential people under his supervision to certain areas of the city or whatnot, based on what crime is occurring. You could do something similar to that within markets. So if there's an area whether it's crypto or leases or special purpose entities, you can do quantitative risk assessment and then use that quantitative risk assessment to guide where regulation is needed or where enforcement is needed. And that, I think, will make markets more efficient. I think that'll do a better job of investor protection, so that we're not, unfortunately, so that we're not all discussing the fraud, the $6 billion fraud or whatever it is, after the fact, but actually getting to the point where it can be prevented when it's only a $500 million fraud, something to that extent.
So, Dan, I want to stick with you for just a minute. What is the role of the regulator in ensuring an orderly transition to financial markets that are increasingly driven by data analytics? And are there guardrails that might help create some more protective measures for participants against abuse?
Yeah, I mean, I think that it's easy in some sense to believe in this myth that somehow prices are efficient, and by virtue of that, investors are protected from fraud. Generally speaking, prices don't anticipate fraud. If they correctly anticipated fraud, there wouldn't be an incentive to commit it. Similarly, for market manipulation, we have seen cases where, to pick up on Michael's example of mortgages, and not move too far away from that, where LIBOR rates were manipulated through a relatively complex scheme. And so I do think that regulators have a role and a job really to keep up with those that are potentially have the capability or the will to manipulate prices or manipulate those concepts that retail investors rely on. So I think that what we're going to see is that either we're going to have a world in which our enforcement and regulatory entities actually embrace analytics, and so that when they get more funds, they deploy that to analytics and they school themselves up on institutional details and how analytics can be used, or they don't. And if they don't, and they allocate more money to, let's say, manpower or enforcement agencies or enforcement lawyers, and just doing the same thing they've been doing for the past 30 years, then I think that those outcomes will not actually help investor protections. So I think really, it's unfortunate, but I think the private sector is way ahead of the curve, way ahead of regulators. And so as a consequence, the government is playing a catch up to that. And you see the consequences of that catch up game basically every day in markets, whether it's a new fraud coming to light or someone engaging in insider trading.
Yeah. Michael, anything to add on the role or capabilities of regulators?
Yeah, I'd put an exclamation point on what Dan said. Look, so the SEC budget in 2022, I think, is around $2.5 billion, $2.6 billion. Last year, JP Morgan invested $12 billion in technology. Now add in the other banks, asset managers, hedge funds, mutual funds. We're talking over $100 billion a year in technology alone. There's simply no way for, in my view, regulators to keep up with the financial sector. The only hope, as Dan mentioned, since they can't compete on scale, is efficiency. And that means embracing data and analytics to try and ferret out any potential wrongdoing.
So it's interesting. I'm hearing both of your responses, and I'm wondering if, because of the scale and because of the volume that the corporate sector is able to apply for analytics, and regulators can't keep up, are we likely to see more cases of fraud working its way through the system because we don't have that same quantity of oversight?
Dan, you want to take that first?
Yeah, I mean, I feel like we should be uplifting and have a happy conversation. But I think you're going to see it in the sense that you're going to have larger frauds. So it won't necessarily, there might be more frauds, but we only see the frauds that actually blow up, right? So the fact that we're seeing the fraud means that it's blown up and it's been revealed to the public. And I think what's going to happen is if the government isn't embracing analytics and the private sector is, including the fraudsters, then I think the frauds are going to get bigger. They're going to persist for longer. They're going to be able to amass more money, and consequently, they'll be more devastating because the frauds, get increasingly complex. Back in the early 2000s, it was special purpose entities with Enron. Now it's crypto tokens and blockchain. And so I think, in some sense, the largest frauds occur due to complexity. And as things get more and more complex, if the regulators stay simple, it'll be harder for them to detect the frauds, and the fraud will get to a much larger scale before it blows up.
Well, I certainly didn't mean to dampen the conversation, but the reality is this is, the challenge that we're faced with. And to your point, you can't prove a negative, right? So we the public don't see all of the ways in which the regulators have been able to prevent or stop crises because they don't become visible. They're not public. We only see the ones that have reached a stage that become quite notorious. But those are, I would imagine, there's a ballast on the other side of that with all of the things that we have been able to prevent.
I think that's right. At least at the SEC, and this is public knowledge, the SEC is really good at catching insider traders who buy out of the money options right before an earnings announcement or an M&A deal. And one of the reasons for that is because they have algorithms out there that they're very public about looking for that particular behavior. But as the insider traders become more sophisticated, the algorithms need to basically be retrained or get more sophisticated to keep up.
Understood. Okay. Michael, greater access to data may increase the risks relating to data privacy and security for all financial market participants. How could we build resilient systems that plug the gaps for potential abuse before it occurs?
Boy, you're beating me up with technology questions today, Erica. Let me see if I can. Let me see if I can address the financial aspect of it, because I think there's an important angle there. And it comes back to something I mentioned a little bit earlier in our conversation. I think consumers need to understand the cost-benefit trade-off behind data access and integration. So let me use open banking as sort of an illustrative vehicle to what I'm trying to get at. Well, open banking has been implemented or is under consideration in over 80 countries, including the US, where it's currently being discussed. So loosely speaking, think of open banking as this concept to ease consumers' ability to share their financial data across intermediaries in fintech. So I'm a B of A customer. I want to move my information over to some online platform. Open banking would make that significantly easier from a technological perspective. Now, this sounds great, right? It gives me more control over my data, in some sense, greater ownership. But when I first heard this, it actually reminded me of that Seinfeld episode where Elaine goes to the doctor and notices that her chart says she's a difficult patient. And so she tries going to other doctors, but her chart has been shared with all the other doctors who now refuse to treat her because she's a difficult patient, right? So, a resilient system that avoids abuse in this setting has to grant consumers, really refined control over what gets shared, when it gets shared, and with whom. Really total control over their data. And I'm concerned that blunt policies coming out of the government in this space may actually have the potential to do more harm than good. So we'll have to see how things progress.
Okay. You handled that beautifully and love the Seinfeld example. All right. So let's think about a new world order in this regard. So, Dan, the table stakes are changing in the financial markets with increased emphasis on corporate citizenry and ESG values. What role could analytics play in that arena?
Yeah, I mean it's interesting to see the focus on ESG, and then now that the economy, people are saying the economy is turning the corner, or we have inflation and the Fed's raising interest rates. Maybe people care less about ESG or potentially care more. And so from my perspective, analytics really offers the opportunity for what I'll consider to be an ESG shakeout. So one of the things we talk about in my class with students is the particular corporation or company really green, or are they effectively greenwashing? And you can think about using analytics to help distill greenwashing versus let's call it true ESG or true green investments. A couple applications are there are satellite images now that you can buy and track where the oil tankers are, to see, for example, whether the company is actually being truthful about what the position of the tanker is. About mining operations or forestry operations, like if a company says they're not clear cutting a forest, you can actually pay to have a satellite look over it and to see whether in fact they're clear cutting a forest. There are interesting applications now for identifying and measuring carbon emissions, right? So there's been a lot of discussion over SEC's proposal to mandate scope 1, 2, and 3 carbon emissions. But you can use satellites and infrared imaging to actually track the carbon emissions at the individual production level. And that information, I think, will help investors and stakeholders who are serious about ESG and committed to ESG actually evaluate whether managers are just talking the talk, or whether they're actually walking the walk. And that, I think, will be helpful. Certainly if we think about corporations as having an interest in the planet and broader society, I think it'll help investors more efficiently allocate their capital to corporations who embrace their values.
And Michael, from your perspective, do you see any link between the opportunities around analytics and ESG and the values that, as a society, we're placing more and more emphasis on?
Yeah, I think there are huge opportunities, because I think that's where, in some sense, the largest gaps are. Right? Analytics can really help define, measure, and monitor DEI, CSR, consumer CSR,
Corporate
and
social
ESG.
responsibility.
Yeah, exactly. I'm getting confused by my own acronyms. Thanks, Eric. Because currently, I think it's the lack of objective measurement, analysis, and transparency that's hindering these initiatives. And let me give you two examples. One, I recently was working with a couple of chief diversity officers through an educational program here at Wharton. And they were really concerned about reductions in their budgets and cutting of resources available to them. And so they're trying to understand how they can make the case more forcefully to upper management, investors, that they need these resources. But the best way to convey the need of those resources is through objective evidence and hard facts that you can't turn away from. Another example is there was a recent research paper, somewhat recent, that actually showed how ESG ratings were being manipulated to reflect higher stock returns. What was being done was that the ratings were changed after the fact to make it appear as if more friendly or greener firms had performed better. But it was precisely because of data analytics that this type of behavior was uncovered. So, really to build on what Dan had said earlier, I think analytics are central for the success and progress of these initiatives going forward.
Thanks. So while I have you, Michael, looking ahead 5 or 10 years, how do you think the impact of data analytics will be felt by investors? And what will that new landscape look like?
Quite different than it does today. Let me try and talk about this a little broadly. So first, I think data ownership, that has to change. In my view, it's the greatest expropriation of wealth in modern history. And from some notion of its scale, look at the combined market cap of companies whose business model depends largely, if not entirely, on our personal data. Social media and search are the two most obvious, but there are others, notably healthcare. Property rights surrounding our data have to change to share some of that wealth and control with us. Second, technological diffusion is going to bring cutting-edge, customized financial planning to households at a negligible cost. Currently, I think it's helpful, but I think it falls well short of capturing the unique traits and preferences of such a diverse populace. For example, consider me. Financial algorithms would categorize me as a married, young, middle-aged, middle-income professional with 2 kids. But that misses so many objective and subjective aspects of my identity that are relevant for my personal financial planning. The increase in data richness and computing capabilities will help my kids, if not me, make decisions in a far more effective manner, and really help with risk mitigation. And then finally, we're actually going to see similar changes impacting the business space in its capital budgeting process, how companies allocate resources, which in many instances is actually largely non-existent, much less residing on the frontier. So I would expect to see decision-making, not just in enterprises, but also SMBs, redefined by both big data and advanced predictive models that are accessible to less technical managers. Because as you noted earlier, Erica, right now there's a big gap between the data scientists and the C-suite when it comes to using data, exploiting data in appropriate manner for business means, and communicating those results.
Well, I'm fascinated by all of this. I have actually learned quite a bit in talking with you. I want to go to Dan for a second because there's a story in the news this week that has garnered a lot of attention, and that's around FTX. What happened there, and what role did analytics play or not play in what we now see as the bankruptcy of this company?
So I think it's timely, unfortunately, that we have this LinkedIn event shortly around the major FTX. I'll use the term fraud. So I don't have any private information here. So all I know is sort of what's been reported publicly in the press. I've been following it for a long time because I'm an accounting professor, so that means I live for accounting frauds, and there hasn't really been a big one in a long time. So What's interesting here is that it appears that Sam Bankman-Fried actually had built a back door into the financial reporting system that he was basically enabled him to make financial transactions and financial decisions without notifying anyone. So in the U.S., in let's say publicly traded company, we would call that an internal control weakness. So this notion that the CEO, without anybody's authority or approval, is able to shift billions of dollars around is generally not something that we see at at major corporations. And so it's been reported that that hole in the system or that backdoor existed, that money was transferred to a related entity, Alameda Research, that most of the company's FTX's balance sheet was based on tokens that FTX had in fact issued, but were not actually trading. And so it suggests that that some amount of regulation is kind of would have been helpful in this case, because if there was a rigorous audit, the level that you would see in a typical, say a Big Four auditor, would have detected this issue. So the other lesson here, and this goes back to the embrace of analytics for due diligence and whatnot, is I think we often, at least in finance, people think of analytics as sort of like the next hedge fund trading strategy, like Renaissance technologies or something like that. But to what Michael was saying is that it's actually being embraced for household finance. It's being embraced for healthcare. It's being embraced to make individuals' lives, even if they're not trading, make them better. I think it's also being embraced more slowly, but we're seeing an increase in it within the private sector enforcement and public enforcement. And it's unfortunate, but that you see uptakes after major frauds occur. So in this particular case, when profits are flowing and FTX appeared to be very profitable, at least on paper, people were waiving due diligence. The identity of the auditor, their presence in the metaverse, the balance sheet would suggest that there was not even a modicum level of due diligence being conducted. And so with analytics, people now think maybe we should do our due diligence. Maybe things are turning the corner. The area of free money is over. And we'll see a renaissance of the use of analytics to protect investors, whether they're major investors or whether they're small retail investors. So we can end on an optimistic note. So one of the silver linings, I think, of FTX is that people are going to put more emphasis on due diligence, and as a consequence, hopefully pay more attention to how analytics can improve that due diligence process.
This is another area of overlap between your interest in scholarship and mine. One of the things that I highlight is that you can be an effective manager of a crisis. You can respond to it, but if you don't also then reflect on the lessons learned from that experience, then you're more likely to repeat the same thing. So here's an opportunity now with FTX, what we've all learned from this experience that might help prevent or mitigate these kinds of issues surfacing in the future. So we have, let's move to questions from the audience. We've had a number come in, and this one is to both Michael and Dan. To what extent do you believe the wide adoption of machine learning and artificial intelligence in finance will bring about a more efficient market and financial system?
Okay.
Michael?
Yeah, sure. So I think it's important to emphasize, and I alluded to this a little bit earlier, right? This is not new. This isn't something that has happened over the last few years or even the last 10 years. Machine learning in its broadest form has been around in finance for decades. So we can look back over quite a few years and get a sense that markets have certainly become more efficient, more transparent, more readily accessible, accessed by a greater proportion of the population. So in terms of efficiency, I think it's fair to say that markets have become more efficient, they've become more resilient, and society has benefited as a whole, at least on net. That's not to ignore, Dan's research agenda that, fraud, continues and will continue into the future. But yeah, I think on net, the improvements have benefited society in terms of better allocation of capital and resources.
Thanks. Dan, anything to add?
I mean, I largely agree with Michael. I think that, one way to think about this is, let's say that, we've got a lot of human traders that got replaced by algorithms. And so if you go back to, say, the 70s or the 80s, where all trading and markets were done by people, that potentially injected human biases into the stock market and into prices. And so if those humans have been replaced by algorithms, you conceptually could imagine a world in which the algorithms don't have those human biases, which are detrimental to, to prices or to market efficiency. However, you may have introduced new biases. So, for example, there's a lot of algorithms that do what's known as pairs trading, or that are focused on correlations between two stocks or between various indices. And as a consequence, those algorithms basically enforce rigid correlations. And so when something odd happens that's sort of outside the algorithm's programming, you can have large distortions suddenly in markets, because the trading's done by algorithms, and the algorithms are correlated with each other. So you could see a flash crash or something of that extent. So I do think that we've removed some of the human biases from prices. And we may have introduced other biases, and I think it's an open question, which one we might prefer, which one's better for society.
Thank you. Michael, a question from the audience for you. How will blockchain technology be implemented in finance and financial analytics in the next couple of decades? And do you think we can use information technology, back to another tech question, to make the process more efficient and less susceptible to corruption and malfeasance?
Okay, let me try and put on my tech hat again here. So, I mean, companies both in and out of the financial space are already employing blockchain technology, right? Which we need to distinguish from crypto, right? But the blockchain technology is really a mechanism in some sense to record information or transactions. Now, how that is going to manifest in the future? Well, think about what finance is at some level. It's a series of transactions, right? It's trades, it's deal flow, it's sales of an asset, you name it. So the question is whether or not it is more efficient to record and store this transactional information on a blockchain as opposed to proprietary systems, centralized systems. I think you can make the case that blockchain is not a panacea, and it won't replace centralized ledgers in certain instances. But in other instances, I think there's a strong argument to be made that blockchain is superior. So let me be concrete with maybe one example. And this is a personal one, because we recently sold our home, right? Title insurance and transfer of deeds of real estate. That seemed right. If you think about the title insurance you have to pay, it's a non-trivial amount of money, albeit small relative to the price of the home. But why can't that reside on the blockchain? Why can't we have distributed ledgers for real estate transactions, which occur relatively infrequently? I mean, that's a massive market with significant sums of money involved, and that's just ripe for that sort of technology. Likewise, mergers and acquisitions, or divestitures, or other restructuring, slow-moving transactions. And I say slow-moving now, but there's no reason in the future that we can't have blockchain dealing with higher frequency transactions. So where exactly it will go, I'm not entirely sure, but there's certainly scope, and we're already seeing it permeate throughout different sectors of the economy.
Great. So we have time for one more question, and it's directed towards both of you. Dan, why don't you start with this one? And I love this question because I think it means it's asked by a younger person. If someone would like a career in financial analytics and innovation, what are some competencies and skills they need to get started?
Okay, so let's do big picture advice for the younger person. and then we can talk about specific skills. I think when I began college and as I advanced through graduate and even when I was, in private practice, I was always taught or operated under the belief that specialization was key. Like specialize in a field, be the best coder, be the best computer scientist, be the best, finance person, the best deal maker, the best salesman. And, I hesitate to give general advice, but what I've seen time and time again is that the returns now, I think, in the labor market are to people who are not the best data scientist and coder and who are not the best salesperson or the best finance person, but somebody who knows a little bit of both and who can act as an interpreter or a bridge between teams of different fields. So someone who can act as a bridge between a finance team that doesn't have any coding or data experience and an engineer team that all they know how to do is code and do data. So I would encourage people getting started in analytics to think about how they can best be that bridge, and that requires knowledge of coding and of data science and also of finance, but not necessarily, if you're interested in analytics, going whole hog in financial analytics in one field or the other. That's not to say we don't need computer designers or software engineers or anything like that. Just like it's not to say we don't need salesmen. But I would say that I think the return now is to people who can intermediate between those two groups, and that's kind of the what I would guess is the insight beyond learning certain languages like Python or statistics or machine learning.
Thank you. Michael?
Yeah, I would. The simple answer: just take my data science for finance class. That's all you need.
Spoken like a Wharton professor.
but more seriously, I can use it as a microcosm really to embody what Dan was saying, right? We're not trying to teach programming. We're not trying to teach statistics. We're not trying to teach finance. We're trying to integrate these seemingly disparate specializations in a manner that allows people to do exactly what you mentioned at the beginning, Erica, which is to become data translators. People who can move seamlessly and comfortably between PhD computer scientists and statisticians, CEOs and CFOs, and customers, right? And to be able to do that, to be a data translator, as I like to call it, you really need to have competency in multiple areas and be able to integrate those competencies into one package. So that's my best advice, is to get that breadth, okay? Because it really will pay big dividends in the long run.
Well, I think that is very solid advice. And I want to take this time to thank both of you, Dan and Michael, for joining me today on Beyond Business. I think it was an illuminating conversation and really an epitome of the way in which Wharton has approached its work. So thank you both for your time. And thank you to our audience for participating in today's Beyond Business conversation. We'll hope to see you at our next event in December when we look at how analytics can help drive social good. Thanks, everyone.